Welcome back, everyone. Today, we're literally tearing into one of the absolute wildest, most volatile setups we've seen in the financial markets lately, the gold market, or XAUUSD, right in the middle of August 2026. We're going to break down the most realistic insights and technical setups from the experts just to see what's actually going on behind the charts.
Okay, let's dive into this. You pull up the chart and you're just seeing gold prices whipping up and down. Massive ranges, totally wiping out both buyers and sellers in a matter of minutes. So what is the core mystery driving this kind of aggressive movement? Look, millions of dollars don't just suddenly shift direction for no reason, right? There's always a catalyst.
So, here's our logical roadmap for today. First, the CPI data event. Second, the impact that has on gold prices. Third, we'll run through the bullish trend analysis. Fourth, the bearish trend analysis. And finally, number 5, trading psychology management.
All right, kicking things off with Section 1, the CPI data event.
This right here is the ultimate fundamental why behind the market's current aggressive movement. We're talking about the U.S. Consumer Price Index, or CPI data, from August 12, 2026. Now, as you probably know, CPI is basically the holy grail for measuring inflation. When that CPI incoming alert pops up on the trading forums, everybody knows a storm is brewing. For the gold market, this is the exact fundamental event that has the power to completely reshape the chart structure in the blink of an eye.
Now, what's really interesting here is how professional traders actually process this data. They don't just stare at one isolated number. They're looking at 3 distinct things: the previous data, the forecast from economists, and then, of course, the actual published number. And the million-dollar question is always, does the actual number create a surprise when you stack it up against the forecast? It's that surprise factor, that gap between expectation and reality, that literally sends a shockwave of panic or euphoria straight through the market.
Moving right along to Section 2, the impact on gold prices.
Imagine a lightning-fast chain reaction that unfolds in milliseconds. Step 1, the CPI report drops. Step 2, instantly, global investors rethink the entire interest rate outlook for the US dollar. You know the drill. If inflation runs hotter than expected, the dollar usually surges. Which brings us to Step 3, gold moves, and it moves fast. Because gold is priced in US dollars, these two assets generally have a strict inverse relationship. And that, my friends, is exactly why CPI Day absolutely guarantees some serious volatility.
All right, Section 3, bullish trend analysis. Let's look at the upside.
So we essentially have a clear map of the current battlefield here. On one hand, experts over at Gold Analysts are mapping out a super aggressive buy zone right between 44.10 and 44.22, basically expecting the whole bullish structure to resume after a quick pullback. But then, on the flip side, sources like Sniper Trades VIP are waving a red flag about bearish pressure. They're laying out sell zones if the price drops below 44.02 with a final do-or-die line of defense sitting at 43.97. This right here, this is the exact zone where the bulls and bears are going to war. Getting a bit more specific with the buyers, bullish sources are locking their sights on some serious upward momentum once the price breaks through that major 4,400 psychological level. The strategy here is to wait for a solid breakout confirmation and then watch those targets expand up to the 44.50 zone. If support really holds firm and the volume keeps surging, we could even see this stretch all the way up towards 44.70. Which brings us to Section 4, bearish trend analysis. Time to flip the script and look at the downside. And this brilliantly illustrates how the exact same market conditions can be decoded in 2 completely different ways. On one side, you've got a very straightforward daily update, clearly laying out the uptrends, downtrends, and those tricky no-trade zones. But then, right alongside it, you have this much more complex, lower time frame perspective from Black Bear Trader that is laser-focused on liquidity hunting. These bears aren't just crossing simple moving averages. They are actively hunting for liquidity traps. Let's actually demystify some of these technical acronyms from Black Bear Trader. So BSL, buy-side liquidity, is sitting right there at the 443.0 level. This is basically a giant magnet. It's where a massive cluster of stop losses from the early sellers are sitting, just waiting to pull the price up. But here's the catch. The bears are actually lurking higher up at the HTFOB, the higher timeframe order block between 44.50 and 44.70. Their play? They are waiting for the price to sweep that liquidity at 44.30, create this spectacular fakeout, and then get brutally rejected at the order block. If that happens, we're looking at a devastatingly deep pullback all the way down toward the 4,300 zone.
So whether you're backing the bulls or the bears today, these are the critical numbers you absolutely need to visually absorb. It's basically a cheat sheet. On the bottom, your key support levels are 43.50 and 43.78. If those snap, the bullish argument totally collapses. Looking up, your massive roadblocks are resistance at 44.30, 44.50, and 44.70. These are the major intersections, guys. This is where the market's biggest decisions are going to be made.
So the crucial point is, Part 5, Trading Psychology Management. Let's do a reality check.
Look, you can have the most flawless technical and macro analysis system on the planet, but if your mindset is a mess, none of it matters. The harsh reality, 90% of retail traders lose money, and it's not because they can't read a chart. It's because of emotional trading. It's over-leveraging, terrible risk management, and just zero patience. When gold starts whipping around wildly right after that CPI release, the FOMO completely overrides their logic. They jump in blind, and boom, their account is wiped out.
So how do you actually make it into that top 10% of successful traders? Well, we've distilled this psychology data down to 5 vital habits you can use on your very next trade. Number 1, always have a plan. 2, strictly manage your risk. We're talking 1 to 2% of your account per trade max. 3, control your emotions. Trade with discipline, not feelings. 4, be patient. Wait for your exact setup. And 5, focus on consistent, long-term growth. Forget the get-rich-quick overnight dreams.
As an investing legend once said, the stock market is a device for transferring money from the impatient to the patient. And that holds incredibly true for gold. During these wildly volatile stretches, like that CPI week in August 2026, patience isn't just a virtue, it is literally your sharpest competitive edge. Don't chase the noise, let the market come to you. So after everything we've unpacked today, ask yourself, are you going to be the hot-headed trader handing over your liquidity or the patient one waiting to strike? Thanks for joining me for this explainer. Stay sharp out there, and I'll catch you next time.